The ETF Trap, How the Debt Engine Absorbs Its Own Antidote. Section 1. Introduction, The Engine That Eats Its Own. Every financial empire has a rhythm, a pulse that beats beneath the surface of commerce and politics. For the United States, that rhythm is debt. Not gold, not productivity, not even innovation, but the ever-expanding momentum of credit creation. Each dollar in circulation is both a promise and a liability, a claim backed not by reserves, but by belief in repayment. In this system, debt doesn't just fund growth, it is growth. The more that's borrowed, the more that must be printed to sustain what's already owed. The US dollar, as the world's reserve currency, turned this mechanism into a global operating system, a network where every trade, loan, and investment ultimately loops back to the same central engine. But like any machine running past design limits, the debt engine now feeds on itself. Its maintenance costs, the interest burden, have outgrown its output. And instead of shrinking or resetting, the system adapts by absorbing everything that threatens it. Gold, Bitcoin, even the technologies meant to liberate people from the fiat web are being securitized and rewrapped into the same liquidity circuits they were meant to escape. This is the paradox of modern finance. Every rebellion becomes a product. Every antidote becomes a derivative. The system's genius isn't stability, it's assimilation. What follows is the anatomy of that process: how debt became the bloodstream of the U.S. economy, how outside money like gold and Bitcoin were captured through ETFs, and why the entire system now hinges on a single equation: whether growth can outrun interest before the credit perimeter consumes its own foundation. Section 2. The mechanics of the debt engine. The United States no longer runs on money in the traditional sense. It runs on momentum. Every new loan, bond, or deficit issue pushes the system forward just enough to keep it from stalling. In this machine, the fuel isn't gold or savings, but credit, claims on future production that must constantly expand to cover both principal and interest. Banks create most of this inside money through lending. When a loan is issued, a deposit appears on the borrower's account. New purchasing power conjured from nothing but promise. That loan must then be repaid with interest, meaning the total stock of debt must keep rising to supply enough liquidity to service yesterday's obligations. It's not a conspiracy, it's arithmetic. At the sovereign level, the mechanism scales up. The U.S. Treasury issues bonds, the Federal Reserve buys or backstops them, and investors, domestic and foreign, treat those liabilities as risk-free collateral. Every layer of the financial system, from mortgages to money markets, is built atop those instruments. When the government borrows, the world gains safe assets. When it stops, the world faces a shortage of them. That is why the debt engine cannot stop without seizing the entire system that depends on it. Economists express this balance with a deceptively simple equation. Debt is sustainable only if the primary fiscal balance is greater than or equal to the difference between the interest rate and growth rate, multiplied by the debt to GDP ratio. If growth equals or exceeds the cost of borrowing, the ratio stabilizes. If interest outpaces growth, the debt spiral tightens, and governments must either run surpluses, repress savers, or inflate their way out. It's the quiet law of every monetary empire. The United States, with interest costs now eclipsing defense spending, has reached the point where momentum itself must expand faster than logic. The system doesn't rely on repayment. It relies on rolling over promises indefinitely. As long as someone, somewhere, is willing to hold the paper, the illusion of solvency persists. But illusions need collateral. And when real growth falters, the machine begins to look elsewhere for it, anywhere value still hides beyond its reach. That is where gold and Bitcoin enter the story. The momentum flow, fire and ice loops. Every debt system oscillates between two extremes, fire and ice. When the engine overheats, money burns. When it stalls, credit freezes. These cycles are not accidents. They are the reflexes of a system that must constantly choose between expansion and collapse. The fire loop begins when policymakers fear deflation more than inflation. Rates are cut, credit expands, and liquidity floods the system. The debt load grows, but so do asset prices, creating the illusion of prosperity. Investors chase yield, valuations stretch, and consumers borrow against tomorrow's gains. Inflation becomes not a bug, but a lubricant. It feels like progress until the cost of debt itself reignites the flames. The ice loop follows when confidence cracks. Defaults begin, collateral values fall, and banks pull back on lending. Liquidity freezes as everyone rushes to sell assets that no one wants to buy. The debt engine sputters because the same credit that once expanded balance sheets now implodes them. Firms fail, unemployment rises, and policymakers, desperate to prevent systemic collapse, return to the fire. Between these poles lies the gray zone of financial repression, the long, uneasy middle where governments keep rates low, inflate quietly, and subsidize survival. Zombie corporations stagger forward, banks roll over loans to avoid realizing losses, and productivity flatlines under the weight of debt service. Growth becomes nominal, not real. The economy survives, but vitality drains from the system. It's a slow-motion compromise, neither boom nor bust, just suspension. The system trades collapse for stagnation, choosing to decay gracefully rather than die suddenly. But each oscillation between fire and ice leaves the foundation weaker, and each compromise requires new collateral to feed the cycle. That's why the system has turned to outside money, assets it can securitize, tokenize, or transform into credit instruments. The same forces that once built gold-backed certificates in the 20th century are now building Bitcoin ETFs in the 21st. And with that transformation, the escape hatch becomes a feedback loop. Section 4, the ETF Trap. How outside money gets pulled back in. Every system built on debt eventually faces the same dilemma. It runs out of credible collateral. When that happens, the machine doesn't stop. It improvises. It hunts for anything with trust, scarcity, or perceived permanence, and then it wraps it in financial paper. That's how outside money becomes inside money again. Gold was the first casualty of this assimilation. Once the ultimate escape asset, physical, bearer-owned, outside the banking system, it was captured through the invention of gold ETFs. Investors believed they were buying gold, but what they received were claims. Electronically traded shares, held in custody by intermediaries, priced in dollars, and fully integrated with the banking and brokerage ecosystem. The gold itself sits motionless in vaults, while the ETF shares are lent, rehypothecated, and used as collateral for yet more debt. A rebellion, digitized and monetized. Bitcoin's turn came next. Created as the antithesis of central banking, a peer-to-peer asset immune to manipulation, it too was domesticated through ETFs and custodial products. Each share of a Bitcoin ETF is a derivative, a claim on coins held by an institution that can itself be leveraged. The underlying Bitcoin may be finite, but the financial exposure built atop it is infinite. Wall Street didn't defeat Bitcoin. It reprogrammed it into a yield-bearing mirror of itself. This is the ETF trap, the process by which outside money is recoded as inside collateral. Once integrated, it loses its insulating power. Instead of weakening the fiat system, it strengthens it, feeding liquidity into the very debt architecture it was meant to bypass. The antidote becomes fuel. From the system's perspective, this is brilliance, a new layer of collateral to absorb excess leverage. From a structural standpoint, it's recursion, the system feeding on its own counterforce. And from a philosophical one, it's tragedy, liberation transformed into leverage. Gold ETFs, Bitcoin ETFs, and tokenized yield products all share the same DNA. They make the revolutionary safe for portfolio allocation, and in doing so, they neutralize it. Every ounce of resistance, once securitized, becomes a building block of the empire it tried to escape. The ETF isn't innovation, it's containment. It turns the idea of sovereignty into another line item on the balance sheet of global credit. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5, Metabolize Resistance, Turning Freedom into Yield. Modern finance doesn't fight rebellion. It metabolizes it. It digests every alternative, every innovation, and converts it into another form of yield. This is how the debt engine sustains itself long after the moral and mathematical limits of debt should have been reached. When an asset emerges outside the system, whether gold in the past or Bitcoin today, it represents a form of discipline. It says, here, finally, is value that cannot be conjured at will. But the system's genius lies in its ability to financialize discipline itself. By securitizing outside money, it converts restraint into leverage, scarcity into liquidity, and rebellion into revenue. Gold ETFs turned vaults into balance sheets. Bitcoin ETFs have turned wallets into Wall Street products. In each case, the freedom that was supposed to stand apart from the banking system became a performance metric within it. This is not conspiracy. It's the evolutionary logic of a financial species built to survive. Anything that can store value, attract belief, or inspire trust will be reconstituted into collateral. It's not theft, it's metabolism. The system lives by absorbing what resists it. In systems theory, this is recursion, when a structure loops back on itself, feeding its own outputs as inputs. Every monetary rebellion becomes an iteration of the same code. Every innovation, from stablecoins to decentralized finance to tokenized gold, ends up orbiting the same gravitational center, the demand for collateral to support more credit. The result is an economy that appears endlessly adaptive, yet grows more fragile with each cycle of assimilation. Stability breeds complacency, complacency breeds leverage, and leverage breeds the next crisis. It's Minsky's hypothesis written in code. Financial stability is self-defeating. Resistance, too, has been industrialized. What was once personal sovereignty, owning gold, running a node, holding private keys, has been repackaged as a compliant product line, complete with ticker symbols and custodians. Freedom itself now trades on the exchange. But this cycle can't continue indefinitely. A system that consumes all alternatives leaves nothing left to absorb. When the last antidote has been securitized, the engine begins to feed on itself. That's when faith, not credit, becomes the final collateral. Section 6. The global dimension. The dollar empire and its shadow. The U.S. dollar is more than a currency. It is an operating system for global finance. Its reach extends through every trade settlement, offshore loan, and balance sheet that relies on dollar liquidity. Even where the Federal Reserve holds no jurisdiction, its shadow rules through the Eurodollar system, a vast offshore network of dollar liabilities created by private banks beyond U.S. borders. This offshore dollar ecosystem mirrors the domestic one. Credit is created through lending, backed not by reserves but by confidence. When a bank in London or Singapore issues a dollar loan, it expands the global money supply without printing a single bill. The debt engine hums not only in Washington but across continents, synchronized by interest rates, collateral flows, and the promise of convertibility. As long as global trade and commodities remain priced in dollars, the system reinforces itself. Foreign governments must borrow in dollars to fund energy imports. Corporations must hedge in dollars to stabilize cash flows, and investors must hold U.S. treasuries to anchor portfolios. Each dependency deepens the network's inertia. The more the world borrows, the harder it is to leave. But the world is trying to leave. De-dollarization is no longer a slogan, but a slow-motion migration of incentives. China, Russia, and much of the global south are conducting trade in local currencies, settling energy contracts outside the dollar, and building payment infrastructure that bypasses SWIFT. The process is uneven, but its direction is unmistakable. Nations are hedging against the dollar's monopoly on credit. The irony is that this movement doesn't destroy the dollar. It exposes its fragility. As global demand for U.S. debt weakens, the burden shifts inward. Foreign buyers once absorbed Treasury issuance as collateral. Now the Federal Reserve and domestic institutions must. That raises yields, widens deficits, and accelerates the imbalance between interest and growth that defines sustainability. Meanwhile, China's export-driven deflation, the mosasaur in our metaphor, quietly undermines the dollar's inflationary logic. Every wave of cheaper goods suppresses global prices, forcing Western policymakers to choose between tightening credit or debasing currency to sustain nominal growth. In both cases, the illusion of control thins. The dollar empire still dominates, but its edges are fraying. For decades, its strength lay in being the only game in town, the safest asset, the deepest market, the universal benchmark. Now, tokenized gold, digital yuan experiments, and crypto-denominated settlement networks offer parallel circuits of trust. Each one siphons a fragment of belief away from the old engine. The dollar's greatest vulnerability isn't competition, it's credibility. Once the world begins to doubt that its debt can be rolled forever, the empire faces the same fate as every over-leveraged system in history: implosion from within. Section 7. The arithmetic of collapse. When growth fails, interest. Every empire ends when its math stops working. For the United States, that math is simple and unforgiving. Debt sustainability depends on growth outpacing interest. If the economy expands faster than the cost of borrowing, debt ratios stabilize or even decline. If interest rates rise above growth, debt compounds faster than the income needed to service it. That's the silent hinge of history. It's what decides whether an empire deleverages gently or falls into financial gravity. For decades, America enjoyed the luxury of growth greater than interest, growth beating borrowing costs. Cheap energy, demographic expansion, and global demand for treasuries kept rates low while output rose. The system thrived on its own inertia. Debt grew, but growth grew faster. Now that relationship has flipped. Interest rates have surged while real growth has stalled. The U.S. owes over $38 trillion, and interest payments alone are surpassing defense spending. A fiscal signal that the debt engine's carrying cost now exceeds its productive capacity. It's no longer borrow to grow, it's borrow to stand still. At this stage, policymakers face three roads, each with its own poison. First, deflationary austerity. Cut spending, raise taxes, shrink deficits. This stabilizes the math, but collapses demand, asset prices, and employment, the ICE loop. Second, inflationary finance. Monetize debt, suppress yields, and inflate away the burden. It buys time, but at the cost of credibility and purchasing power, the fire loop. Third, financial repression. Keep rates below inflation, trap savings in negative real returns, and slowly melt the debt in silence. This is the most politically survivable path, but it's a quiet theft, a long confiscation of the future. The empire will likely choose the third, not collapse, not revolution, but erosion. A managed decay where the nominal machine keeps running, even as the real value of its output dissolves. That's what happens when the growth engine can no longer outrun its own interest bill. Debt stops being a tool and becomes an organism, one that consumes what it once powered. At that point, every dollar printed to sustain the system only deepens its dependence. Hyperinflation is not inevitable, but stagnation masquerading as survival, that's the base case. And each cycle of suppression demands new collateral, new illusions of productivity, new narratives to keep the machine believing in itself. Bitcoin ETFs, gold ETFs, AI bubbles, all different masks of the same logic. Each promises liberation, each ends up collateralized. The system continues not because it is strong, but because it is recursive. It has learned how to turn decay into duration. Section 8, the only exit, outside money that stays outside. There is only one kind of money that can break the loop. Outside money that stays outside. Not tokenized, not securitized, not wrapped in synthetic yield or turned into an ETF, but held directly and deliberately as a counterweight to the system's own recursion. Outside money has three forms: gold, Bitcoin, and real production. Each represents value that cannot be created through credit expansion. Each carries its own form of discipline: scarcity, decentralization, or tangible output. But only when these assets remain unfinancialized do they retain their power to check the debt engine. When gold is stored in a vault and sold as an ETF share, it no longer stands apart. When Bitcoin is held by BlackRock instead of by people, it no longer threatens fiat, it feeds it. When productive capital is financed through debt rather than equity, it ceases to generate wealth and starts generating obligations. The challenge is not technological, it's psychological. The system persists because people prefer convenience to sovereignty. They accept the illusion of ownership so long as the number goes up. That's how resistance becomes yield and freedom becomes a fund. The true exit then isn't about abolishing the dollar or dismantling the Fed. It's about refusing to let every alternative be captured. Holding real Bitcoin, not derivatives. Owning real gold, not claims. Investing in productive work that yields something tangible. Energy, food, tools, ideas, not just financial returns. The paradox is that such discipline cannot scale easily, and that's precisely why it matters. A decentralized economy of real value would grow slower but last longer. It would trade infinite liquidity for enduring solvency. That's the future the ETF Trap tries to prevent. A world where money once again means something, where credit is earned rather than conjured, and where growth serves life instead of servicing debt. In that world, outside money is not collateral, it is a boundary, a line the system cannot cross because it refuses to be written into its code. Section 9. Conclusion. The arithmetic of empire. Every empire begins with conquest, peaks with confidence, and ends with compounding. The United States built the most efficient credit machine in history, a system that turned debt into diplomacy, deficits into demand, and paper into power. But the arithmetic never changed. When interest exceeds growth, the burden compounds. When collateral becomes illusion, the empire consumes itself. And when even rebellion is financialized, there are no external forces left to restore balance. This is where the US dollar empire now stands. Not yet collapsing, but converging toward entropy. It has absorbed its rivals, monetized its critics, and securitized its antidotes. Gold, Bitcoin, even digital innovation, all drawn into orbit around the same gravitational core of credit and yield. Every solution becomes substrate. Every safeguard becomes leverage. The ETF Trap is the final expression of this recursion, a system so adaptive that it can repackage dissent as investment. It survives not by creating value, but by recycling belief. And belief, like liquidity, is finite. When faith fades, mathematics takes over. If growth cannot outpace interest, the empire faces its terminal equation, a choice between debt deflation or currency debasement, between ice and fire. Either the machine freezes or it burns. But in both endings, the story remains the same: momentum mistaken for money. And yet, there's one thread of hope: outside money that stays outside. Uncaptured, unwrapped, unleveraged. The gold bar in the hand, the private key in the wallet, the field that feeds without a futures contract. Each one a reminder that real value does not require permission to exist. Because in the end, the empire's arithmetic is not fate, it's feedback. It tells us what we've built too high, borrowed too far, and believed too easily. And when the last illusion folds into its own reflection, what remains will be the simplest truth in all of economics: what cannot be printed endures.